Good morning. I'm Karl Kaufman, and this is the Morning Market Minute for Friday, June 3rd. No matter how much evidence exists that seers do not exist, suckers will pay for the existence of seers. J. Scott Armstrong. Wall Street analysts, the well-paid prognosticators that frequently appear on CNBC and generate headlines with their reports, hold enormous sway over a company's fortunes and its shareholders. Why should we, as individual investors, place so much emphasis on what they have to say? Look at Apple today. It's down over 3% after a Morgan Stanley analyst wrote that slowing App Store growth could cause weaker services revenue. Analysts are paid millions of dollars a year. Their firms have the most expensive algorithms and predictive models, yet they consistently miss the mark with their predictions. The market, however, responds to these reports as if they were gospel. Analysts are prone to groupthink. Once one analyst changes their rating or price target, others quickly follow suit. This often happens after a company surprises with an earnings beat or news about the company is released. At this point, the market has already priced the news into the stock. Spencer Jacob, a former analyst for Credit Suisse and currently a writer for the Wall Street Journal, wrote about his former profession. Analysts are, as a group at least, like the farmer who bolts the barn door after the horse has run into the meadow. When a stock drops based on an analyst report, the markets may be overreacting to misleading or false data. These drops may be hard to swallow as long-term investors, and we're subjected to them every quarter. Analysts publish their earnings expectations, and a company's stock is affected by whether or not they meet those expectations. There is limited focus on the long-term outlook, and analysts typically have no accountability for frequently missing their estimates. One prominent investor who disagrees with analysts is Warren Buffett, who said, "The idea that you're going to spend loads of time trying to guess how many iPhones will be sold in a 3-month period totally misses the point. Nobody buys a farm based on whether they think it's going to rain next year," he added. "They buy it because they think it's a good investment over 10 or 20 years. Analysts frequently use what is known as channel checks to gauge supply and demand. They visit Apple stores and interview employees and survey customers. They interview Apple suppliers such as Taiwan Semiconductors and, based on computer chip orders, extrapolate those numbers to the entire supply chain. This approach is myopic and consistently fails to be an accurate barometer for Apple. CEO Tim Cook complained about this in a January 2013 earnings call, stating that Apple has a vast and complex logistics chain with many moving parts and manufacturers. So who really benefits from analyst reports? Hint, it's not individual investors. And why do analysts make so much money? According to an academic study called Inside the Black Box of Sell-Side Financial Analysts, private communication with management is a more useful input to analyst earnings forecasts and stock recommendations than their own primary research. Analysts have a chance to talk privately with management, but do they get the whole story? If they're talking to management for only 20 to 30 minutes, how much information can they possibly glean from that? And what about an analyst's bias? As U.S. News and World Report contributor Wayne Duggan wrote, "It doesn't take a genius to see that the fastest way for an analyst to sour a relationship with company management is to slap a sell rating on the company's stock." According to an anonymous analyst, when a company cuts you off, not only do you lose the information value of that, but you actually lose revenue. The company won't come to your conference, therefore your conference is going to be less important. Clients pay a boatload for that access. Clients also sometimes pay for privileged information not shared with retail investors. In 2013, Citigroup was fined $30 million after an analyst forwarded confidential information about Apple supply checks to institutional clients like SAC Capital Advisors, a hedge fund formerly run by New York Mets owner Steve Cohen, and T. Rowe Price. If you're an individual investor, it still may be beneficial to pay attention to what analysts are saying to understand the sentiment surrounding a stock. However, it is crucial to take this with a grain of salt as you do your own research and come to your own conclusion. Despite the attention heaped on them, analysts' predictions are no guarantee of anything. Analysts may be paid to be seers, but that doesn't mean you should end up as the sucker. I'm Karl Kaufman, and I hope you have a wonderful weekend.